Hey everybody, it's Terry. I will do a quick overview video of the signals, the scans that I use and post, and sort of how they work and how I use them. I'll go into detail about each of them in different videos, but I'll just give you like a broad base look at this stuff here. All the scans are based around swing trading. It's probably one of the easiest trading methodologies. It can be used across multiple time frames. It can be used in bull markets, bear markets, ranging markets. It's a really versatile trading system, and all it requires is trend identification, recognizing momentum, and finding support and resistance. Like, that's basically all you need to do this. The scans that I post are usually in different time frames. That's important because the way that I swing trade is based around time frames. You'll want to take information from one of these charts and use it and analyze your positions based on that specific time frame. So if I take a signal from the 1 hour time frame, like scan, I'm only going to want to be looking at the 1 hour chart for YFI. If I'm looking at a 4 hour scan, I only want to be looking at the 4 hour chart of Tomo versus BTC. You want to stick to that time frame for the individual trades, because the scans and signals can be different across time frames. A 15-minute or 1 hour signal bullish can be just an upwards wave in a downtrend on the 8 hour scan, because that's how like markets work. Like, you can't always be in alignment. So you want to keep your trades in the relevant time frame. That's how you'll have the most success, and not get like stopped out all the time, or how you can catch the long-term big moves. So that's that point. Now we'll go into the signals. The first one to really take note of is the number 1. I labeled it number 1, bull trend confirmed or bear trend confirmed. We don't have any of those on here, but that is the starting off point. The methodology that I use to determine trend involves 2 moving averages, a higher moving average of, a moving average of highs and a moving average of lows. And then that is compared against Williams average. I can't talk right now. Williams accumulation and distribution, but I'll get into that later. When the bars are above the moving averages, then that's potentially a bullish trend. If the bars are below the moving average, that's potentially a bearish trend. When the bullish trend or the bearish trend signal pops up, that's just something to pay attention to. If you're in a trade on one of those symbols and it pops up, a bearish trend confirmed, and you're in a long position, you might want to go look at that chart and see if you should cut out of it, because the market may be coming back on you. But again, this is important because the scan needs to appear in the relevant time frame. So if I was in a long position on Pax Gold on the 1 hour chart, and then this signal popped up, I would want to look at that chart, because I might need to get out and just take my money where I've got it, because price could be dropping. Next, I don't typically trade off of this signal, but it could be used for a trade. A lot of folks in here are really good at drawing the patterns. I know Josh has posted a little graphic that he made and did an awesome job of, that showed different bar chart patterns that are bullish and bearish, blah blah blah. Say price has been in like a descending triangle or bear. I don't know. I don't use those things enough. But say price is in like in a descending triangle, and you have like the first bar like sort of closing above that. If that happens in conjunction with like a bull trend confirmed signal, that could be a reason for you to enter into a long position, because you have two separate signals telling you the same thing at the same time. And that's really what you want to look for when you're trading. You want different signals confirming the same thing. So that's one way that like the bull trend confirmed could be used to enter into a trade, because this is a trend signal that would be matched to a price action based signal or some other different oscillator or whatever. The next signal is the bull swing and the bear swing. This one is really the most important one. Anytime one of these pops up, that signal automatically goes onto a watch list for me. This is multiple bars over the moving average channel that I talked about earlier. It's got a high statistical probability of continuing the trend when price pulls back to the lower moving average in the the lower moving average in the channel. So what I'll do is when this comes up, I put it on a watch list, and then I'll set an alert for when the price touches that moving average, that lower moving average. So it'll just sit there for however long it needs to sit there, and I'll reevaluate it every, like depending on the time frame, like let's say it's a daily scan or an 8-hour scan. I'll pop in every new 8-hour bar, and I'll see if the entry still looks valid, if I need to move up my entry point and move it down, or if I need to not just cut out of it altogether. But the bull swing and the bear swing signals are they're probably the most important thing off of this whole scan, because those have the most, like they'll occur the most frequently, and they are the most reliable signal for profitability. The number 3 condition, the strong bull swing and strong bear swing, that is when you have multiple of the number 2 condition popping up. They are just as valid as the number 2, the bull swing. The only reason they're a less important criteria and condition for me than the number 2s is because a lot of times the strong bull swings can be really risky trades. A lot of time these occur when there's been an extreme move to the upside or an extreme move to the downside, and returning, like they've separated very far from your dynamic support, whether that be a moving average or VPOC or I don't know what else people use for support, but price has separated very far from that support zone. So to come back to it is a very long way, and that can, like price returning to that support can be enough to turn the trend bearish or bullish, depending on if you're to the long or the short side. So if price comes back too quickly, that can turn the trend, and you can lose all of your potential for your bull swing or your bear swing, because like price is just in a free fall. When price does that, a lot of times that's when I'll look on the next higher time frame for an entry, or I'll look or I'll look in a lower time frame and just watch the momentum or look for divergence to see when that like falling knife is cutting out, because the signal is still valid even though price is like really retracing. You just don't want to have like a buy zone set and just let it get blown out because you weren't paying attention to it. But anyway, sorry. Strong bull swing is a good signal. It's less important to me than the regular bull swing signal, just because not a lot of times, just because it can get taken out if price retraces too fast. That can happen in the number 2 conditions, but it's less likely because price has not exploded so far past its support. Retracements are smaller percentages and not usually enough to flip the trend. The signals down here, the 2 below, the 1 above, the one above, the 1 below, the 2 above, and the 2 below, these are actually trade conditions, but they're sort of weird to explain, and I didn't really want to do that until I got into a better position to explain them. These are usually counter trend. Well, not counter trend. These are contrarian signals. So we'll do the 2 below. This means that price is in a general uptrend, but it has retraced below the moving averages. When that happens, the other half of determining trend for me is the Williams accumulation and distribution. If that is still showing bullish, even though price has fallen below the moving averages, then the trend still remains a bull trend, and a lot of times the price will bounce back up above the moving average channel. Same thing with the 1 above and the 2 above, still bearish. Price has been in a general downtrend, but it has retraced above the moving averages, but Williams still shows it's a bearish market, so you can still expect that price will return back down. And this is just like it's just a rally that's going to be short-lived because the trend is still down. These are usually based around like a 1 or a 2 bar trade to whichever side. So like a 2 above or 2 below, like whenever you have 2 bars below the moving average channel, you can enter in a trade and just close out the next profitable close, but I'll get into that stuff later. Those are the scan conditions. If there are any questions, let me know. If this is confusing as shit, let me know, and I'll try to make it better, but this is just an overview. Thanks.